Yeah, we had the FOMC, we had the Fed giving a pause on the rates. Pretty interesting, right? We see that the FOMC had I would say, not a controversial aspect, but the rate pause was widely expected already by everyone in the whole financial industry, to be honest. And then we had some good questions from the reporters, from the journalists, asking Jerome Powell some good questions about what he thinks about the tariffs, how is the tariffs going to impact the economy, the household spending, the household effect, etc., etc. So that is a good topic for us to be talking. So we're going to be discussing lots and lots of things today. But primarily, we're going to be looking at just an overview of the Federal Reserve and the FOMC, because still, some people don't know what's the Fed is and what's the FOMC. They just know that's the central bank. But yeah, and what's next? So I sort of thought about that when I was writing the script for today's webinar, and I was like, I always talk about the central bank, but I don't really tell them what the central bank do or what what's the so that's pretty much it. Okay. Then we're going to talk about the March 2025 FOMC meeting. So this meeting, the comparison of the economic projections from December last year and March this year. Remembering we only had 2 meetings this year, one in January and another one now in March. Last year, the last one we had was in December, and they did release an economic projection as well. So that's definitely some good aspects for for us to look. Oops, sorry. There you go. Then we're going to be looking at the comparison of economic projections. Then we were going to be looking at the historical perspective on the MP, so the monetary policy, and of course answering questions as usual. So if you guys have any questions, always send it over on the chat, or if you want to unmute yourself and talk to me, that's completely fine as well. But before we go any further, I have to put it up the risk disclaimer as usual. So, all right, let's get to the start. Let me take this off, and let's come to this big boy. Federal Reserve. Okay. So as I was saying, I reckon that the best thing, first of all, would be to give a brief overview about the Fed, what they do, who they are, and etc. when they were established, and etc. So the Federal Reserve, majority of the people know them as the Fed, just the FED, and that is the central bank of the United States, right? The Fed was established in 1913, so a long time ago, but not too long when you think, and the primary objective of the Fed is to promote maximum employment, stable prices, and try to, moderate the long-term interest rates. And these are, collective goals known as the Fed dual mandate. So every time that the Jerome Powell comes in and say, look, we are following our dual mandate, that's exactly what he's trying to say, trying to promote maximum employment as the economy sort of goes forward, ensure that the prices are stable, and moderate the long-term interest rates policy. Okay. So the Fed is one thing, the FOMC is another thing. Okay, so the Fed is the central bank. And then inside the Fed, we have the FOMC. That's the Federal Open Market Committee. Okay, the FOMC is a very crucial component of the Federal Reserve System, and from the Fed. Fed, just FED, represents Federal Reserve System. Okay, and basically, it's responsible for looking at the market operations, which are the principal tools used to regulate the supply of the money and the credit in the economy. As well, the committee meets very regularly to assess the economic conditions and just determine the appropriate monetary policy actions. If they do cut, if they do hike, if they pause, setting the target range for the federal funds rate, etc. So very, putting on a very simple perspective here, the Federal Reserve is pretty much the heart of the financial system from US, as any other central bank is. Okay, so we go to we go to Europe, we have ECB that is going to do exactly the same. We go to China, we have POBC, People Bank of China. And then we go to Brazil, we have BOC, Brazilian BCB, Brazilian Central Bank. We go to Australia, we have RBA. We go to New Zealand, we have RBNZ. We go to Canada, we have BOC. So it's everywhere, and they are basically an institution controlling the whole economy pretty much. If they want the economy to go faster paced, if they want that things grow quicker, because just to stimulate the economy, they probably will maintain the rates very low. So the borrowing cost of the mortgages or any loan for open new business would be very cheap. So that will generate more and more and more and more and more business on the society. Therefore, we'll be bringing GDP up, bringing PMIs up, services, manufacturing, and etc. So they have the total control of the economy in one click. But there's a big thing here, that they can really mess it up the economy very quick as well. The same way they can make this good, they can make that bad, and they can make really bad, really, really awkward. Okay, and that's true. Not knowing when to rise interest rates, or when to decrease interest rates, or keeping rates too long, too high for long, too high for too long, or don't even caring about inflation. Printing money as like a normal paper, just printing will generate inflationary pressures. Like governments, most likely on emerging markets, that happens a lot. But we have like Brazil, for instance, in 2019 to 2020, we had one president that was called Bolsonaro, and that guy was, making Brazil a greater place in terms of economic, because he's from the right side of the politicians. And then now we have a left person into power that is called Lula, and that guy is pretty much making a deficit into the country, basically like spending more than what he can. Okay, so making billions and millions of reais, that is the country currency, and then the bank didn't have money to pay. So what they have to do? Well, they have to print more money, and then they go print more money, and then the inflation goes higher, and then that's exactly how it goes. Okay, so yeah, the central bank has a really big power, and just so you guys understand, that's the principle of fundamental analysis. You have to understand those guys to understand Forex. I know it sounds very, so difficult, but it's literally so simple. The central bank can adopt two instances, hawkish, dovish, or neutral. Okay, so basically three instances. Hawkish, there will be, looking to grow the economy. They're going to be, looking to pretty much higher rates. Dovish, exactly the opposite thing. lower rates, they're being much more less aggressive towards monetary policy, and neutral is just data dependent. They're going to be doing whatever they do depending on the data. So if the data comes high, they will assess the data, and then the committee will judge to be right or wrong to raise or decrease the rates. Okay, yeah. So 1913 was when the central bank was established. Okay, perfect. So let's talk about what matters. So let's come back here. Let me send this link to everyone so everyone can follow along. Oopsie. All right, cool. Send it over on the chat. Here you can find all of the meetings since 2020. Okay, so since 2020. So, or you can just come up here and click on here. Okay, so on March 19, as we can see here, between 18 to 19, in Australia was at the 20, so we're always one day ahead. Anyway, so on March 19, the FOMC concluded the two-day meeting, and they released a statement saying that the monetary policy decision and the economic assessment. Okay, so we have two releases on this side. So we have the statement that we can click on HTML, and that page will open to us. And we have the projected materials that we're going to be looking at in a second, but that's I would say much more in-depth content where you can judge, let's say like that, you can judge the economic projections from one meeting to another. It's not always that they do those releases, okay? If I'm not wrong, it's like every second meeting. So if we go to 2024, we can see that. So statement and no projection, and then statement and projection, no statement, no projection, statement, projection. So every second meeting, that's how they do it. So basically, this is a good material because you can just come back and revisit and see what they said and what they've changed. Okay. Of course, the key outcome of the meeting was that the decision to maintain the target range for the federal funds rate at 425 to 450, and that decision. Sorry, I'm on the wrong page here. Right here. Okay. And that decision reflects as they always say, the committee cautions approach amid the pretty much volatile economics uncertainty. But there's several factors influencing this decision. That's exactly what matters to us. Because remember what I said yesterday, if we come back here into FinLogic's economic calendar, we can come into tools and then economic calendar. You can see right here that was widely expected, 4.5%. So no changes. Okay. If they came here and do like a completely different thing than this, then that would be definitely an interesting point, I would say. But they didn't. So it's completely fine. Okay. Because the market was expecting that already. Now, what's the factors that are influencing the decision of the Fed to maintain the target rate unchanged? So, at 4.5, 425. I guess there are like 3 points that we really need to talk about. And the first one is the economic activity. The second one is the labor market. And the third one is the inflation. And I've mentioned that on my video today that I've sent on the Telegram. But pretty much the economic activity, are showing some recent indicators, that's suggesting that the economic activity has continued to expand at somewhat of a solid pace. And they can see this here, recent indicators suggest that the economic activity has continued to expand at a solid pace. And the employment rate has stabilized at a low level in recent months, and labor market conditions remain solid. Inflation remains somewhat elevated. But anyway, so the commenter noted that the uncertainty around the economic outlook has increased, particularly due to the recent policy changes, including the tariffs, and from Trump and any other trade measures that Trump may adopt. And that, of course, will shake the whole central bank. Why? Remember I told you, there's the bad side and the good side of tariffs, right? The good side is that people will most likely recur to items that are made into USA. And the bad side is that they will have to spend more to buy the same item. So think about it. If you live on US and you go to buy a pair of shoes that are made on Canada, for instance, well, that pair of shoes used to cost you $50. Okay, so let me just get my pen. So you go and buy your shoes, and that shoes used to cost you $50. Okay, so that $50 now has a 25% tariff on top of that. Okay, so how much is 25% of 50? So 50 times 0.25, that is $12.50. So now that is actually costing you, oh, there you go. So now that is actually costing, so equal to $12.50. Okay, so that pair of shoes is not $50 anymore. It's costing you the same shoes, $60. Okay, so $62.50. So that's the price you're going to pay now. Forget about the 50, you're not paying 50 anymore. You're going to be paying 62 and 50. Okay, so basically you're going to be using more money to buy the exactly same thing, and that's generating inflation. That's devaluing the money that you have, the power of purchase. Okay, maybe, just maybe, that's the reason why we saw some small retail sales the last release, but I'm not too sure if that's the impose of the tariffs. I'm not too sure. I don't think it would have anything to do. But anyway, it's just thinking out loud here. Now, the second point that I've mentioned is the labor market. So as they say, the unemployment rate has stabilized at a low level in the recent months, and the labor market conditions remain solid. That is good, but there's a problem as well, because if we have more people working, we have more people with money, right? Not a problem if we have like 100,000 new people on the workforce or something around those numbers. But the problem is if they're expecting 50,000 and it comes to be 200,000, that's a big problem. And if the average hourly earnings goes up as well, meaning that those people have more money to be spending. And I can definitely show you a very simple chart that you will understand me. Do you think people will still stop to spend? Do you think inflation will stop people to spend money? No. The credit card is on its highest point at the moment. Why? Because it's not because there is an inflation people will stop to spend. We have to spend more. Okay? It's not about, oh, there's inflation, I can't spend money. Oh my God, I can't buy these shoes for me. No, it's not about the money. It's not about the shoes. It's about household costs. It's about food for you to live. It's about rent for you to have a shelter. It's about energy for you to be able to take a shower, for you to be able to charge your phone, be able to use your mobile or whatever you want to watch TV. It's about appliances that have been expensive. So people don't have money, but they have credit. And if they don't have credit now, they request for credit. And what will the bank do? Of course, they will approve. So it's simple, okay? So the credit card is on its highest level on US at the moment. And that is sad because people don't have cash flow. They have credit. And being in live to, paycheck to paycheck, it's definitely not a good option on those types of economy. And the last thing, but not least, is of course the inflation. Inflation is decreasing. Okay, we can't just close our eyes and think that that's not doing anything, man. I mean, come on. Well, they are, okay, but it's a bit harder than just like that. So the inflation is very sticky at the moment. There are some projections indicating a rise to 2.7% by the end of 2025, from the previous estimate of 2.5. So 0.2% higher than what was expected to be until end of this year. So somewhat of an inflationary aspect towards the end of this year. And that's going to be interesting to see if that actually happens. Maybe we're going to have a stronger US dollar. Okay. One of the reasons that we may have a stronger US dollar. Okay. Cool. So that's pretty much it from, the I would say the factors influencing the decision of the Fed of maintaining the rates and not cutting or anything like that. Now, one thing that I like to do is that's very interesting is comparing off the economic projections from December 2024 and March 2025. Okay, so for that, I've opened up the 2025 here. 2024, December, perfect. So that's pretty much what we're going to need. So that's March 19, so that's 2025, and that's 2024. Okay. So pretty much what we're going to need to look is at those numbers here. Perfect. Okay. Let's start into the GDP. Really interesting how they predicted to be 2025 at 2.1%, right? So the gross domestic product was expected to, so the economy, all right, takes that very simple. The economy was expected to grow to 2.1% into 2025 for the whole year until 31st of December 2025. So 1st of January to 31st of December 2025. In 2024, it was expected to grow 2.5%. I think that's what it grows around that level. But then when we come to, that's in December, okay? So that's the December 18. You can always check it right here, December 18, and that's another one that's this month, okay? Maybe not on this column. And that's the 19th of March. Okay. All right, cool. You guys can see that. Now, let's go for this year. Ooh, that's not good. So 0.4% less. Okay. And they've downgraded from 2 in 2026 to 1.8, 1.9 in 2027 to 1.8. So no changes in growth between 2026 and 2027. And the longer run, 1.8 from 1.8. Okay, so that's interesting because they just did a contraction of the economy. And that downward revision reflects, the concerns about the potential dampening effect of the recent trade policies, as well from Trump administration and the economic growth. Okay, so that's really, really interesting. Now, unemployment rate is really important as well. Was to be 4.3 for this year in 2025. Okay, that's from December to now, and now is expected to be 4.4%. Okay, so slightly uptick, and that's suggesting, at least for me, that the expectations, there's a modest softening, right? There's a modest expectation of a softening in the labor market conditions. The inflation now, that is the PCE, so the PCE inflation, PCE inflation, those numbers here, to longer run. So expected to be 2.5% in December projection, 2.5%. And now March projection is expecting to be 2.7%. Ooh, 0.2% higher. So as I've mentioned before, there are expectations of a higher reading on the inflation by the whole year in the last month of this year. So I guess this is going to be really sticky, and that's the reason why the Fed won't cut 3 times and maybe only 2 times from now. It's only 0.2. The longer run's still at 2%, of course, no changes at all. But I guess that 0.2% will make investors sort of, okay, they've upgraded the inflation target. So interesting to see that. Let's see how the market reacts. Okay. And that's pretty much attributed to the impact of the newly imposed tariffs, of course, which are expected to raise prices on important goods that I've just mentioned to you guys and make more inflation, or make the inflation stickier. Okay. Now, these are pretty much the most important ones. You can go through everything later if you want, of course, but these are the overview. That's what you sort of need to look at it. Okay. Cool. So what are the implications for monetary policy? Well, the Federal Reserve current stance are reflecting a very delicate balancing. Okay, so there's some inflation concerns that the inflation projects to rise above the 2% target, and that the Fed remains very vigilant about the price stability of the things of the economy. There's a growth slowdown, as we just saw. The downward revision in GDP growth is indicating some cautions about the monetary, about the sorry, I forgot the name, about the economy. And that is it's a very, if we have aggressive cuts, that could be a counterproductive and is lowering the economy. And of course, the future rate cuts, despite holding in the rates today, the Fed projection is suggesting the possibility of 2 rate cuts later in 2025, as I've mentioned it. Upon, of course, incoming economic data, because there are some involving conditions. But if we look on the CME, we can see that the market is not pricing any cuts for May. It's pricing a 25 basis points cut for June, no cuts for July, no cuts it's pricing 1 cut. A second cut of the year will be in July, no cuts here, and no cuts in December. Okay, well, that's slightly off a cut. Yeah, no cuts on December. A little, man, there's a 32% chance. That's very hard. I still believe only 2. CME is telling 3. That's hard. I don't think they will. Only 2. What's the aggregate? Yeah, see? Yeah, 90% of the market is expecting these to happen. 325. Yeah. Anyways, yeah, I reckon only 2 cuts for this year. For the later in the year. But that's, of course, it's going to depend a lot onto the economic outlook and what the Fed is looking for, the projections, how they're believing on inflation or not, etc. Okay, so if we look to a broader context on the economy, there are some factors like the trade policies, the implementation of the tariffs from Trump is introducing some significant uncertainties, I guess, and that's going to contribute to the higher inflation and potential constraints on economic growth, and that's maybe why they downgraded the GDP as well. Of course, the whole global economic condition at the moment, sluggish growth, majority of the economies, in major economies, the geopolitical tensions, these will all add layers of complexity to the US economy outlook. And, market volatility shifting, investors are, shifting the sentiment, and this can impact the economic activity and consequently the monetary policy decisions as well. I guess if we look to the Federal Reserve communication strategy, it's of course is one of the most important aspects of the Fed, approach to the MP, to the monetary policy. It's providing the clear guidance on the policy intentions and economic assessments, and the Fed aims to manage market expectations and reduce the uncertainties that are going on, giving some sort of forward guidance. If you guys remember, in recent years, the Fed has enhanced the transparency for the market, and that's why we have access to those economic projections, because the release of the summary economic projections, this is called the SEP, the SEP. These offer a lot of insight into the FOMC participants' expectations for the economic indicators, like the GDP, PCE, labor market, etc. And that sort of indicates what they will probably be doing with the federal funds rate. So the other point is the press conference. Regular press conference by the chair, by the Fed chair, Jerome Powell, is providing opportunities for us to elaborate on policy decisions and sort of try to address some questions from the media, try to understand what the media is trying to ask them, etc. Of course, official statements, the daily statements from the policy decision, as we have every decision, and that's due very not long. Okay, so it's really cool to see how things are getting well into the market. Cool. So I guess for me, it's pretty much it. If we look at the interest rates decision on the US dollar index, pretty much nothing happened. It was here. Pretty much nothing happened because the market was widely expecting that, and what Jerome Powell said wasn't a surprise. So pretty much still ranging at the same levels of 104 to 103. Okay. Most likely we're going to break out down and we're going to follow up to 100. That's around my target. Let's see how this goes, because one thing that will probably make the US dollar even weaker would be more tariffs. Okay, if more tariffs comes up, the US dollar weakness will probably continue to be a very problematic thing, in my opinion. Okay, cool. So that's pretty much it from me today, guys. I don't want to be, just talking. I think that's it. I think we had a pretty good week. A lot of trade opportunities. We saw the market going up, going down, coming back to the same spots. But next week will be even more, because it's going to be rebalancing portfolio week. Always the last week of the month is a rebalancing act that they do. So it will be very interesting to see how the market will react. Besides that, thanks everyone for following me this week. I hope you guys have a wonderful weekend, and I'll chat to you next Tuesday. Stay safe, and see you there. Bye-bye, guys. Thank you.